All right, hello, and welcome back to the Broken Business Models podcast. We're your hosts, Ryan and James. And before we get started, just a quick disclaimer, nothing in this podcast or any of our other material should be taken as investment advice. James and I could have positions in any of the stocks that we may mention today, and we reserve the right to change those positions at any time. So always make sure to do your own work and consult with a professional before making any investment decision. With that being said, the topic of today's podcast is going to be the EV charging companies. So, just a quick background in case for those of you who have forgotten. Back in 2020 and 2021, during the during the broader SPAC mania of the pandemic, one of the areas that got caught up in that was EVs in general, and EV charging stocks also got caught up in that as a way to kind of indirectly play the rise of EVs. And so, in case you don't remember or didn't quite realize just how big of a deal these EV charging stocks were at the time, I just put a couple of headlines here from back in around that time, talking about the billions of dollars being projected to be spent on building out EV charging infrastructure, and the billion-dollar SPAC deals taking some of these previously unknown companies public at insane valuations. Fast forward several years to the current day, and EV charging infrastructure in this country has largely been built out, especially around large population centers. So if you take this map of the density of EV chargers around various parts of the country, you can see that in all the major population centers around like the East Coast, San Francisco, Los Angeles, all the major places that you'd expect already have a very high density of public EV chargers. And so the EV charging infrastructure has largely been built out to a large degree. You can also see this if you look at the numbers of total EV charging locations in the country. So in this chart here, that's the yellow line represents the total number of public charging stations. And so you can see that in 2021, there was indeed a massive increase. The number of public charging stations almost doubled. But then the very next year, that tapered off to only about, give or take, 10% growth by 2022, and similarly in the subsequent years. And so at the same time as EV charging stations have tapered off, we also see a large influx of suppliers for EV charging hardware. So if you just search for EV charger on Amazon, you'll see a large number of what appear to be very, very competitively priced EV chargers from any number of different companies. So you have this dynamic where you have tapering off demand for EV chargers and an influx of very, very affordable supply. But what about the business of operating these EV chargers? So it turns out that operating EV chargers is very economically challenging for a number of reasons. Firstly, the throughput of any one EV charger is extremely low because it takes so long to charge one car. So if you think about in contrast to a regular gas station where one car can fill up their tank in just a couple of minutes, one EV might take hours at the EV charging station between the time that it actually takes to charge and the time that maybe the owners were not paying attention and fail to drive their car away within a reasonable period of time. In addition to that, the EV chargers are very expensive to install and do require periodic maintenance. In fact, sometimes they're also frequent targets of vandalization and theft due to the copper parts inside of them. And so they frequently have to have maintenance people called out to replace or repair these charging stations. And these expenses, due to the very low throughput of these charging stations, these expenses eat away at the revenue per charging station significantly, making it very hard to generate a profit. So all of that taken together, the performance of these EV charging companies, both the business of creating and selling the EV charging hardware, as well as operating the EV charging station networks. All these companies involved in either of these businesses have suffered massively since 2021. If you just look at a few of the most well-known pure play EV charging companies, virtually all of them have had their stock prices go down in a straight line since 2021. And some of them have decreased in value by 10 times or more since their peaks. So the entire EV charging industry is in very difficult financial situation. But today we're going to talk specifically about BLNK charging, which in our opinions is one of the most interesting and in many ways one of the worst of the EV charging companies. So with that, I'll hand it over to you, James.
Yeah, thank you. So we'll be talking, as Ryan just said, about BLNK charging. And, just like all of the other EV charging stocks, back in 2021, this was very hyped up. There was a lot of investor excitement. The stock price got up to around $50. Since then, it has declined massively, about 98%. And as we speak today, its share price is down at just about $1. So clearly, the business has not been doing very well. And here we can see their, consolidated financial performance. They have incurred operating losses since inception. Now, previously, at least they were growing, right? Back through 2022 and 2023, even as they were losing money, well, at least you could say the revenue was growing. However, since since the end of 2023 and throughout 2024, the revenue has actually been declining. So not only is the business losing money and has always been losing money, now even the revenue is declining. So it's clearly not looking good for BLNK charging. Now, BLNK charging has three main business units. Now, firstly, they design and manufacture their own EV chargers, and then they sell those chargers both to consumers, individuals who own EVs, as well as businesses who want to set up and operate their own EV charging station. Now, in addition to selling the chargers to third parties, BLNK's second business is they will also use their own chargers to build their own public charging stations, which they operate and generate revenue by selling electricity to customers. And then finally, they have the third business segment, which is BLNK, the BLNK network. And what the BLNK network is basically the BLNK mobile app and the software that powers the app and powers the chargers. And if you are a third party that buys a BLNK charger to set up your own charging station, let's say, for example, you own a restaurant and you think, as an additional stream of revenue, it might be a good idea to buy a BLNK charger to put it in the parking lot of your restaurant so that your customers can also charge their EVs. And then you as the restaurant owner, you own that charger and then you get that revenue. Now, you can pay a fee, like a monthly fee to the BLNK network, and then you get access to the BLNK network. And what that does, when you are part of the BLNK network, your charger will show up on the BLNK mobile app. So an EV owner who has the BLNK mobile app, they can see that, oh, you indeed have a charger here. So then they can go to use the charger. And also the BLNK network, they have all the software that supports the payment processing, etc. So that's kind of like a service, an additional service that they offer after they sell the charger to a third party operator. So those are really the three main businesses, right? They sell the charging hardware, they operate their own charging stations, and they have this BLNK network, software and mobile app service. And then finally, they also own a car rental service in Los Angeles, but that's really too small to matter, and we're not gonna focus on that. So really, we're just gonna look at their three main businesses. So here you can see their three segments in this bar chart. Again, it's actually four segments. The yellow part is this they have this car rental business that's only operates in Los Angeles. It's small, subscale, losing money, and really not even worth talking about because it's so small. So the three main businesses are the product sales in blue. That's the selling the chargers themselves. The company owned chargers in orange, and then the Blink network in gray. We can see that historically, the vast majority of Blink's money is the blue bar. The vast majority of their revenue is the blue bar, which is the sale of the actual charging hardware. However, around 2023, Blink's management team realized that due to the intense competition in the charging hardware market. So as Ryan alluded to earlier, you can just go on Amazon and see many dozens, if not hundreds, of different brands that are selling EV chargers. And this huge amount of competition has brought down the prices of EV chargers. This has made it such that it's very difficult for Blink to generate a profit given how low the prices have come. So they made a strategic decision to reduce that business, to reduce the product sale business, and they will instead be focusing on their own company owned chargers. So that's why the revenue has been declining so much over the past year. See, that decline has come from that blue bar has really been declining, and that's intentional on the part of the company. And they hope to replace that over time by increasing the orange bar, which is the company owned chargers. Now, one thing we have to understand is that there are multiple different types of chargers. There are level 2 chargers, and there are DC fast chargers, which can also be referred to as level 3 chargers. Now, a level 2 charger, general rule of thumb. This obviously can differ based on a variety of factors in the specifics of your EV, but in general, if you're trying to fill up your EV's entire battery, say from 20 to 80%, and you go to a level 2 charger, that will take you quite a long time. Could be 4 or even 5 hours. The level 2 charger is pretty slow. Now, the level 3 charger or the DC fast charger is much faster. It can generally give you a full charge on your EV in about 45 minutes. And the majority, for example, the majority of the Tesla superchargers are level 3 chargers. They can charge your car very, very quickly. We believe that the vast majority of Blink's chargers are level 2 chargers. We will get into that later. Now, the economics of a level 3 charger, we believe, are much better than a level 2 charger. And the reason is the throughput. If it only takes an hour to charge your car, you can charge a lot more cars in a day and generate a lot more revenue in a day. Obviously, if it takes 5 hours to charge a car, you're not going to be able to get nearly as much throughput and you're not going to generate as much revenue. Now, obviously, the level 3 charger, the DC fast charger, is more expensive and costs more to install, but it will generate much more revenue. The level 2 charger is not going to generate nearly as much revenue. Now, as we talked about earlier, they have the Blink network. So they're the third parties who purchase Blink, third party businesses who purchase Blink chargers to set up their own charging stations. They will often opt into the Blink network and get access to the Blink mobile app, etc. As of the most recent quarter, which was the third quarter of 2024, Blink had a total of approximately 61,000 chargers across the United States on the Blink network. Now, of those 61,000 chargers that are available on the Blink network, approximately 98% of them are level 2 chargers, with the remaining 2% being level 3 chargers, right? So the vast majority of the chargers that Blink makes and sells are level 2 chargers. Now, while there are 61,000 chargers in total on the Blink network, the vast majority of those are owned by third parties, owned and operated by third parties. Blink only owns and operates 6,400 public chargers that it actually owns. Now, Blink does not disclose how many of the company owned chargers are level 2 versus level 3. However, given the fact that 98% of the chargers on the Blink network as a whole are level 2, it's probably safe to assume that the vast majority of Blink's company operated chargers are also level 2. And as I explained earlier, the level 2 chargers can generate much less revenue per day than a level 3 charger. So how much oh yeah, so here we can see that over the past year or so, really the past couple of years, Blink has indeed been investing significantly in building out its network of company owned chargers. And this is as they pivot away from the product sales, which they say that's a worse business. They think they want to increase their number of company owned chargers. So as of back in 2022, they had about 4,000, a little over 4,000 company owned chargers out in the out in their network. And then as of the third quarter of 2024, this has increased to 6,400. So over the past 2 years, they have um, they have built and deployed approximately 2,000 new company owned chargers. So, what is the economics of these chargers? So, on this chart, I have graphed in each quarter the revenue generated per charger as well as the gross profit generated per charger. So, when you go into a Blink charger, you go and charge your car, you charge your EV, and you pay Blink for that charging. Well, what are the costs associated that Blink has to incur? Well, obviously, there's the cost of the electricity. Blink has to pay for that electricity. And then the other major cost is the rent. So generally, you want to put the charger in some high traffic area, and then you have to pay whoever owns that land. You have to pay them rent to have your charger there. So that's the gross profit in these orange bars here. That is the revenue minus the electricity costs as well as minus the rent expense. Now, Blink does not disclose how much they spend on maintenance. They don't separately disclose that. So we don't actually know how much money they spend on maintenance, but it's likely significant because, the chargers will break down, etc. You need to send somebody out there to repair it. Blink does not disclose this. So our calculation of gross profit is actually very generous because it does not even include the maintenance expense. But even so, we can see that in the most recent quarter, they generate about $800 per revenue per charger that they have deployed, and they make approximately $200 of gross profit. And if we annualize that, $200 of gross profit per quarter, that's about $800 of gross profit per year. So one charger that they deploy out in the public, they'll make about $800 per year of gross profit. In reality, it's even worse than that because it's actually lower than that because there's also maintenance expense. But, we just won't consider that for now because they don't disclose the maintenance expense. So the charger doesn't last forever. Eventually, the charger will wear out. Remember that these chargers are out in the open. They're exposed to the sun and the elements, and they're exposed to vandalism and thievery because sometimes people will, break open the charger and try to steal some of the copper or other electronic components. So because of that, Blink depreciates its chargers over an estimated useful life of approximately 5 years. So the assumption is that once you deploy a charger and install it, it will last approximately 5 years. Now, if you're making $800 per year of gross profit, you will make $4,000 of gross profit over the entire lifetime of that charger. So how much does it cost Blink to deploy one of these chargers? Well, we know that between the fourth quarter of 2022 and the third quarter of 2024, Blink spent approximately $20 million on capital expenditures. It's probably safe to assume that the vast majority of that spending went to deploying new company-owned chargers, company-owned public chargers. During that same period, Blink's number of company-owned chargers increased by approximately 2,000. So if you divide those two numbers, that gets about $10,000 worth of capital expenditures per charger. Now, the reason it's so expensive is because it can cost a lot of money to have the charger installed and to have all the electrical wiring rerouted, etc., to supply electricity to it. So these are very expensive. Now, if you look at that number, $10,000 of total capex per charger that is deployed, versus the charger is only going to generate $4,000 of gross profit over its entire lifetime, well, that's clearly a losing proposition. You're going to be losing money by doing that. So that's why, I'm very skeptical that Blink will ever be able to reach profitability by increasing its number of company-owned chargers. And then we can see here that, as we said earlier, Blink has incurred operating losses since inception, and cumulatively, they have burned almost $250 million of negative free cash flow. And as of the end of the third quarter, Blink only had about $65 million of cash on hand. They're burning about $10 million per quarter. Now, they say that they want to expand their charging network. Now, if they really do double down on expanding their company owned charger network, well, that costs a lot of money. So, if they really do accelerate that, then the rate of cash burn could actually increase. Now, given the $65 million of cash that they had, plus a $10 million per quarter cash burn, they're on track to run out of cash around the beginning of 2026, give or take. So they have a little more than a year's worth of cash burn left. And, and at this rate, within about a year from now, they'll run out of cash. Now, what are their options to raise additional capital? Well, historically, they've relied on dilutive equity raises, dilutive equity issuance to fund their operating losses. Well, that's easy to do when your stock price is at $50, but now that your stock price is only at $1 and Blink's market cap is only about $100 million, if they continue to try to fund their losses through continued equity issuance, well, that's going to cause a huge amounts of dilution. And, given how low the stock price is, they're going to have to issue a lot of new shares to, to raise significant amounts of capital. So I think this is really not going to. I think the outlook for this company is very bad. They're running low on cash. The business is losing money. The unit economics are very bad, as we just discussed. And I think the most likely situation, just my opinion, is that over the coming years, we're probably going to see Blink Charging have to file for bankruptcy at some point. So that is about everything we had to talk about today. As always, if you have any opinions or thoughts about Blink Charging or EV charging in general, please let us know in the comment section below. And we will see you all in next week's video.